Last week, I watched a video by Graham Stephan about how to save 99% of your income. I was so shocked at the fact that this video actually wasn't clickbait. Graham Stephan explained that by making smart financial decisions, such as saving on housing costs through what's known as house hacking, and using credit cards to collect flight miles so that he's able to travel for free, he is genuinely able to save 99% of his income. But there is a catch to this video, because the only way Graham is able to save 99% of his income is because he happens to make over $2 million a year. And that's such an absurd amount of money to be making each year. And I'm pretty sure he makes a lot more than that now. And that's the only problem I had with this video. It's not realistic for most of us on ordinary incomes to be saving that much each year. Because if we were to save 99% of our incomes, we would be left with like $50 to spend each month. And that can just about get you a lovely piece of real estate in one of LA's most sought after neighborhoods, Skid Row. So I wanted to make a video to show how normal people making a normal amount of income can save 50% of their money. I'm also going to cover where you should be investing the money you save, so that in 20 years you can reach the point where your investments cover your living expenses, so that you can, theoretically, if you'd like to, retire. And this advice comes from my own experience, where for the last year, I've been able to save well over 50% of my very normal income, which has allowed me to be able to buy a house and make other investments at the age of 22. Okay, so let's get into how it's possible for the average single person to save 50% of their income. Well, it all starts with how much money we make, and according to the data, in 2021, the average person in the US makes around $50,000 a year. Now, the majority of people seem to have a spending problem, not an income problem. But with that being said, it's also pretty hard to save money if you're not making very much of it. So if you make less than $50,000 a year, you probably have to find a way to make a little more money by either getting a new job or starting a side hustle. But let's assume you're the average person making $50,000 a year. Then after taxes, you should be left with $40,800 a year, which is $3,400 a month. So that means in order to save 50% of our income, we have to find a way to make sure that our expenses don't exceed $1,700 a month, so that we can save the remaining $1,700 to invest, so we can achieve our goal of being financially independent in 20 years. So now we need to create a $1,700 monthly budget. I want to show you all what an example of this might look like. The first and usually biggest expense we have to account for is housing. I found that the average one-bedroom rent in the US is around $950 a month, so that is what we're going to assume. We'll also assume around $150 for utilities. Another expense that we're going to have is a mobile phone plan, and we're going to assume $40 a month for that, and that will usually get you quite a good plan. Next up is car expenses, and we're going to assume $100 a month for insurance and $60 a month for gas. Next is our entertainment budget, which accounts for things like going out with your friends and all of that, and we're going to assume $50 a month for that. Then we have our food budget, which is $200 a month for groceries and $50 for eating out. And then we're going to assume $50 for clothing and finally $50 for miscellaneous expenses, because there's always going to be something that comes up and you can't usually fit it into one of the above categories. So I think this is a very reasonable budget, and I don't think it's overly frugal, because on this budget you can still go out to eat with your friends or even go to the movies. I don't think it's a good idea to be extremely frugal to the point where you have to miss out on fun or creating memories just for the sake of saving a few extra dollars. I remember watching a Graham Stephan video where he explained that he would try to save money even when he went out to eat with his friends. He would actually go to Subway before he met up with his friends at the restaurant, and then when he got to the restaurant, he would pull out his sandwich and eat that instead of ordering any food there. And that's a level of frugality that I have to admire, but it's not something I recommend that you penny pinch to that extent where you can't even go out and order food at a restaurant because you're trying to save every extra dollar you have. You'll also notice from the budget that in order to save a large portion of your income, you have to get the large expenses right. You can't live in a luxury apartment downtown, and you can't take out a massive loan on a brand new car. If you have any debt besides a mortgage, then you have to pay that off first, otherwise it's going to be impossible to save most of your income. Okay, so now that we've figured out what it takes to save 50% of our income on an average salary, the next thing I wanted to talk about is what we should be investing that money into to provide consistent and good long-term returns that will make it possible for us to retire in 20 years. I recommend investing into a broad stock market index fund. This will diversify your investment over hundreds of the highest quality stocks the market has to offer. An example of a broad stock market index fund is Vanguard's VOO Index Fund ETF, which tracks the returns of the S&P 500, which is an index made up of 500 of the biggest and best companies in the US. Basically, if you were to invest in this index fund, you would own a tiny portion of each of the 500 stocks that are included in the fund. I like index funds as a long-term investment for a couple of main reasons. The first reason is that when you invest into index funds, you pay very little fees or no fees at all. The majority of index funds have expense ratios below 0.1%, whereas actively managed funds often have expense ratios above 1%. So that means that index funds can have a 1% or more advantage over actively managed mutual funds before the investing period even begins. Because of compound interest, that 1% saved can translate to tens or even hundreds of thousands of dollars saved over time. The second reason I like index funds is because they financially outperform the majority of mutual funds. Although most of us enjoy trying to beat the stock market and outsmart hedge funds, research has shown time after time that index fund earnings are much more consistent. In fact, many hedge funds will try to mimic the holdings of an index fund. The third reason is because of diversification. Everyone should have a well-balanced portfolio, and index funds achieve this. All of us can't spend hours trying to purchase a little portion of hundreds of stocks. So instead, we'll most likely end up poorly diversified by owning just a few stocks. So index funds give you as much diversification as possible when it comes to stock investing. And finally, the last reason I love index funds is because it's simply just easy. Most of us have jobs and don't have the time to spend hundreds of hours trying to make good stock picks. It's so much easier just putting most of your money into an index fund, not having to worry about selling it or trying to time the market, but just hold it. And maybe check in once or twice a year and just have the peace of mind that your investments are going to do very well in the long term. Historically, the S&P 500 has returned around 8% annually when you account for inflation. So if we were to invest the $1,700 that we save each month into an S&P 500 index fund and receive an 8% return, then in 20 years' time, our investments would grow to the amount of $933,544. So the next thing I want to talk about is how much money invested do we need to be financially independent? Well, there's something that financial planners use called the 4% rule. This is a rule of thumb used to determine how much money you're able to withdraw from your investment account each year without reducing your overall balance. So if we apply this 4% rule to this example of the average person who saves and invests 50% of their income for 20 years and builds up a portfolio worth $933,544, then they're able to withdraw $37,344 every year without reducing the value of their portfolio. And if we divide that number by 12, then we have the monthly amount we're able to withdraw from our account each month, which is $3,112. And after tax, you're left with around $2,500 a month. And the key to being financially independent is having this 4% number be greater than our living expenses. And in this case, the $2,500 a month is greater than the $1,700 a month that we budgeted for our monthly expenses earlier. So in this example, we would officially be financially independent. And there's also an $800 surplus to spend every month, since the $1,700 budget required us to live really frugally, and most of us don't want to live like that long term. I also want to add that if you reach this point, you don't have to stop there. You can continue to work and make money to grow your investment portfolio larger until one day you can eventually replace your job income with the passive income from your stock portfolio. And of course, this is all a theoretical example for the average person. Everyone's circumstances are different, and maybe you can't live off of $1,700 a month where you live. But the point of this video is for you all to start on a path towards creating financial independence for yourself. You should create a budget in order to save a large portion of your income, stick to your budget through living frugally, invest what you save, and sleep peacefully knowing that you're on the path towards financial independence. So that's it for the video, guys. If you enjoyed, please let me know by hitting that like button down below so more people can see the video as well, and it can hopefully help them be financially independent. But thanks so much for watching, and I'll see you in the next one. Take care.